The economy is steadily weakening and will eventually end up in a recession. As far as the markets are concerned, I think they're overhyped, overpriced, and in bubble territory. The problem with that is it's fine to be able to detect a bubble. A lot of people are starting to worry about a bubble, but it's very difficult to predict whether the bubble will actually pop and when that would occur, or whether the air will just slowly go out of the bubble and we'll have valuations reach, shall we say, reasonable levels. And we don't know when that would start and how long it would take. There are actually two decisions that people have to make with regard to bubbles. If you decide to go out, that's one decision. But if you decide to go out, you're eventually going to have to decide when to get back in. And it turns out that the record of people pulling out and then going back in is not good. That gets to another point, and that is my own experience is that it's kind of a Charlie Munger rule. You have to be very patient, and you can be looking at something for 2 or 3 years before you buy it. Now, since we started on this markets and portfolio, another thing is that, shall we say, younger folks, the prudent thing is probably to be a little bit biased to just staying the course. But older people should be looking at their portfolios because they probably have big capital gains. And let's say they have a traditional, want to use a 60-40 rule, 60% stocks, 40% bonds. Just assume that's the case. Well, now, if they went back and looked at their portfolio, maybe it's like 80 or 85% stock. They have a huge capital gain. So the recommendation there would be you rebalance the thing. That would be my instinct. And the reason for that is the following. And this gets back to the thing that makes the economy go around, and kind of my theme song, money dominates. It's all about the money supply. And what happened with the pandemic, we had a huge increase in the money supply. At one point, we actually had the money supply growing at a little over 18% per year, which is the most rapid rate of growth in the money supply measured by M2 since the founding of the Federal Reserve in 1913. So what happens after that big injection? The first thing that happens, asset prices start going up. So real estate goes up, land goes up, stock market goes up, all assets start going up. And who owns the assets? Well, the people with a positive net position on their balance sheet are people who are older. Younger people, it's negative. Some older people, it's negative too. But to put this thing into context, if you looked at the billionaires in the United States and took their wealth as a percent of GDP in January of 2020, the month before the pandemic hit, it was 14.1%. Now that percentage is 21.7%. So who made out by this surge in the money supply, surge in inflation, surge in asset prices that we've had? Well, people who owned assets. Well, they tend to be, on a demographic basis, older people. So right away, intuitively, I know that they must be very heavy into equities. This is very interesting. Now, this chart, it's actually better than my billionaire thing. Now, the lesson we come to is actually something that is contained in my new book that I co-authored with Matt Sakurki. It's called Making Money Work. And we argue that one of the key things and objectives of monetary policy should be neutrality. What's neutrality? When the money supply changes one way or another, it should be neutral as much as possible in terms of its effect on different sectors of the economy and different income groups. And your chart shows this is what the Fed, in conjunction with the fiscal authorities in Washington, have done. The politicians have made for a non-neutral monetary situation. That's the Fed. And the fiscal part of the thing is also in there because taxing and spending is not neutral. It favors certain groups. And it turns out that whether you're conservative or whether the limousine liberals are running Washington, they're all doing the same thing. They're favoring special interest groups, and they're making the income distribution in the United States worse and worse and worse. And of course, what does that give fuel for? Number one, it gives fuel kind of ideologically for people on the left. All the Marxists jump on this thing and raise hell about it, and I think that's bad. And at the practical level, it makes society anxious. And as you pointed out, we're finding now what happens with young people. They graduate from college with a lot of debt and none of the assets. They haven't accumulated any assets. You know, when I graduated from college, I had a huge balance sheet. I had that because I was working on the farm and all kinds of construction jobs and everything else. When I was in high school, I was making money. I had a bank account and there was something in the bank account. Then I went to college. And in addition to that, I always had 3 jobs at the same time. I learned very quickly when I was a kid, there's nothing more important than a balance sheet. There's kind of 2 parts to this. So based on the quantity theory of money, money supply is essentially where the stock of money today is more or less where it was about 2.5 years ago. So you basically had a contraction, Adam, in the money supply, and now it's started increasing a little bit. And the rate of growth in the money supply in the United States is 4.5%, if we use M2 as a measure of the money supply. And the rate that is consistent with hitting an inflation target of 2% and based on the quantity theory of money would be just a tad over 6%. Let's just call it 6%. So right now the rate of growth is 4.5. The rate consistent with hitting a 2% inflation target is about 6. And that suggests to me what? The trend of inflation. The course of inflation is down. We're at 2.7 now. The month before it was 2.7. Everyone said because of tariffs it was going up. Well, I said no, it was probably going to stay the same or go down or certainly not go up very much. So that's the underlying cause and behind where inflation is going, because inflation is always and everywhere a monetary phenomenon. How much money in the system dictates where the overall aggregate inflation, like the consumer price index, where that's going. So it's going down. And one way to put it, the monetary policy now is tight because the money supply at 4.5% is less than the rate consistent with the 2% target of 6%. So we're in a tight money zone, and that's why the thing is trending down. Now, there's a little problem, and that is we have this whole regime changing with tariffs, and who pays them? Number one, forget what they tell you in Washington, D.C. The importer, the American importer, pays all the tariffs. Foreigners don't pay the tariff. That means all imported goods are going to be faced with a sales tax, and that tax will be added to the price of whatever these imported items happen to be. And it's very high. Right now, the Yale Budget Office calculates that the effective tariff rate that we are going to be facing right now, 18.2%. The Smoot-Hawley tariffs, which were the highest in the United States and put a stake in the heart of the Great Depression in 1930, the Smoot-Hawley tariffs, they were only just a little bit over, I think they were 19.7%. And now we're at 18.2. So this sales tax is huge. Now, to put it into context, if you look at the estimates of what they think the revenues will be generated from these sales taxes, or as they call them, tariffs, it will amount to about half of the so-called tax cut that was associated with the big, beautiful budget bill that was just passed. So we just passed a much advertised by Trump and company and many other people. The big, beautiful bill extended the tax cuts of 2017 and made those permanent. So what has happened with the tariffs, in a way, you can think of money going into the taxpayer's pocket because he's not gouged by increases in taxes due to the big, beautiful bill, but it's going to be taken out. About 50% of that bundle going into his pocket, half of it's going to be taken away with these tariffs, which are a sales tax. So it's a very big deal. Trump's using this for leverage, you say. I'll put a negative spin on it, Trumpist, and that is, we have a tariff today on you. But what if you don't deliver what you say you're going to? Then I'm going to jack the tariff up on you. And that's what's going to happen in Europe. You said all these investments coming in. The EU promised to send 600 billion in additional investment in the United States. Well, the EU has no authority. They can't mandate that private companies in Europe invest $600 billion in the United States. The whole thing thing is smoke and mirrors. And by the way, most of these things aren't written on paper. They're not signed by anyone. We don't know what in the world is actually going to happen. So there's not the fixity about the bad Smoot-Hawley tariffs. There is a great deal of uncertainty about and flexibility in this idea that we're not just using leverage for economic reasons, but for kind of as a weapon of choice. I mean, this is warfare we're talking about. The configuration of manufacturing in the world is settled kind of in a general equilibrium, as we'd call it in economics, and things settle where there's a comparative advantage of settling it there. David Ricardo, the great British economist, worked all this out a long time ago. The comparative things end up where they have a comparative advantage to being produced, and that's the way it is. Now, Trump wants to upset the apple cart and change all of that. And he says, I don't like this market arrangement. I want to rearrange the deck chairs in another way. And when you do that, that simply makes you go from, in quotes, optimal low cost to some higher cost regime. What's going on? And this is a continuation of Biden, by the way. It's not Trump. Biden had exactly the same philosophy. The difference in Biden, of course, he wasn't the sharpest knife in the drawer and wasn't as fast and as comprehensive as Trump. But the ideas are the same. The philosophy is the same. And the philosophy is an interventionist philosophy where the government knows best. Trump knows best. He wants the CEO of Intel fired because he doesn't think the guy's any good. He wants to run the American economy as Trump Enterprises. But don't forget, that's exactly what Biden was doing. And that's been a pattern. We've been sliding down this slippery slope for, what do you think Obama was doing with Obamacare and all these other interventions? Ultimately, it is a power game, and what we say, everything is becoming more politicized. You can't do anything now in life without having a politician having their finger involved in the thing. You're facing some regulation or some sanction, or you're receiving maybe a subsidy. If you've got a good lobbyist and you're on the right gravy train,